I didn't necessarily expect that the US would be able to unify Europe in a way that Europeans themselves have not necessarily been able to unify in recent years. But here we are. I run sort of the International Growth Fund, so it's a large cap oriented international growth fund. My sweet spot for investment, multi-year structural growth stories, high barriers to entry businesses at attractive valuations based on my earnings forecast. And I tend to run a low turnover portfolio, 20 to 30% over time. Why? Because I am looking for these multi-year structural growth stories, high barriers to entry businesses, and those don't tend to change that often. And one metric I use, though not the only one, is pricing power in real terms at every point in the cycle. The last 6-9 months is the first time in my tenure that I've been overweight the UK, which is, again, not necessarily a function of the fact that I'm a wild bull on the UK domestic consumer, but I think more a function of the fact that you have these great franchises that have derated significantly and where I'm seeing opportunities. European stocks look cheap relative to their global counterparts, and I'm trying to find these kind of market inefficiencies. Companies that are on the periphery where actually the resolution doesn't really matter. Is it 25% tariff or 10% tariff or 0% tariff or 50% tariff? There are some businesses where maybe the stock is selling off aggressively, but the answer to that question is not that material to the business. Those are the types of opportunities that I'm actively looking for as we're speaking.